Welcome to DeFi by Design, where we talk all things blockchain and cryptocurrency while striving to educate, empower, and enrich.
What's going on, guys? Real quick break for the DeFi by Design podcast sponsors and the DeFi Slate sponsors who make this all possible. First, we have 𝗵𝗶𝗴𝗵, a money market protocol that allows you to borrow and lend and leverage your assets to earn interest, right? So if you want to deposit some stable coins in there, currently you can get 3, 4, 5, 6, 8% APYs on stable coins, which oust any bank in the world. As far as we're concerned, you can deposit any Ethereum-based asset that is listed there, borrow against it. You can borrow stablecoins. You can borrow other assets like ETH or YFI, Link, even the 𝗵𝗶 token itself. 𝗵𝗶 is the go-to protocol for any sort of borrowing and lending. Check it out at app.𝗵𝗶.com. The next one we have is 𝗃𝗃𝗃. 𝗃𝗃𝗃 is a new crypto wallet, 𝗃𝗃𝗃.com. You can store all of your crypto there. They have quite a few options. They're integrating new DEX features soon and allow you to have a non-custodial way to store your crypto safely off of centralized exchanges and also just not in a MetaMask or in your own ledger. A bit of extra security there. Next, we have 𝗵𝗶𝗃. 𝗵𝗶𝗃 is a decentralized perpetual swap protocol, basically allowing you to trade on leverage on the Ethereum chain, right? They're coming out with V3 very soon. By the time you're listening to this, it might already be out. They are a super solid team, and they're pumping updates and allowing you to trade decentralized perpetual swaps on ETH, Link, and a few others, all on Ethereum, all decentralized. So that is 𝗵𝗶𝗃. Next, we have 𝗵𝗶𝗃. 𝗵𝗶𝗃 is a decentralized stablecoin. It's an algorithmic stablecoin that is pegged to the purchasing power of commodities. And basically, it measures what value $1 buys in terms of a commodity index each week. And then it provides you with essentially a store of value that allows you to continuously evade inflation while maintaining, a stable aspect as if it was $1. And that is the 𝗵𝗶𝗃 protocol. Check them out on Twitter. Finally, we have DeFi. It is an L2 decentralized exchange. They allow you to basically trade in a gasless and feeless manner, big volumes, whatever quantities you need. It's almost like a centralized exchange on Ethereum, but you are the custodian. They do not hold your coins as a centralized exchange would. You have full control, full power. So really, it's almost like a centralized exchange capabilities on a decentralized exchange, and that is DeFi. All those sponsors make this possible. I know it's a lot to take in, but thank you very much for listening, and let's get back to it.
What's going on, guys? We're here. It is January 17th, a few weeks after our first recording with the Cover Protocol team. We have 𝗵𝗵𝗃 and DeFi Ted here, some of the nicest guys in DeFi. You'll see Ted all over Twitter helping noobs out with this, that, and the other, making educational points. 𝗵𝗵𝗃's in the background getting after it. So we are excited and a bit weary to learn and talk a bit about what happened with the Cover Protocol hack, which was on the 28th or the 27th in that time. It depends on what time zone you're in, of course. And we're going to explain kind of what happened and hear what Ted and 𝗵𝗵𝗃 had to say about their revival. Obviously, we want to learn about what happened in a chronological event, but we're definitely keen to hear about what the revival is going to be, how the Cover Protocol has pushed out of this, and everything in that matter. So welcome, Ted and 𝗵𝗵𝗃 again. It's good to have you guys back after holidays.
Yeah, thanks, Andy.
Yeah, thanks for having us.
Yes, sir. Yes, sir. All right. So Twitter blew up one day. Cover Protocol hack. Token is dumping. Talk us through that day for you guys. What did it look like on y'all's end? Obviously, boom, you guys are on your computers trying to fix this as best as you can or figure out what's going on. What did that time look like when you first figured out what happened with the hack? And yeah, what did that first day kind of look like?
Sure. So this 𝗵𝗵𝗃 here. I'll take over. So it was really, everything was unfortunate about it, and obviously we still just feel terrible about what happened. But the exploit occurred in the middle of the night for most of the team. So when we first realized that excess minting was going on, the only people that were awake were myself and Ted, actually. And unfortunately, what that meant is there was nothing that we could do because we needed the 𝗵𝗵 wallet to shut off the farming contract. And we weren't able to do that for another 3 hours. Obviously, I didn't sleep, but there's nothing I could do on my own. So until 𝗵𝗃 woke up, there was nothing we could do to shut it off. And by the time he woke up, we did shut it off. But unfortunately, one of the exploiters had already minted, like 40 quadrillion tokens or something. So for all intents and purposes, Cover token was worthless at that point. So a little bit about the vulnerability. Basically, It was a vulnerability in the farming contract for cover. It didn't affect any of our core contracts. So any of the funds that were staked, the core operation of cover and providing coverage for protocols, that was all operating. It was our token itself that had the vulnerability. And it was really as simple as one line in the code needed to be 5 lines higher, and then everything would have been fine. It was just an oversight, and it was missed by a lot of people. It was missed by our auditor. It was missed by lots of people in the community that reviewed the code, and obviously by the team as well. It was actually discovered by accident. A user did some actions in a certain order and realized that they minted slightly more tokens than they were supposed to. And then based on that, they were able to figure out that if they did it in a certain way, they could actually mint an unlimited number of tokens. And so there were multiple people that discovered this around the same time, because after the first exploiter discovered it, other people that were watching, doing on-chain analysis and stuff, realized what was happening. And they started to investigate. And so then we ended up with some people that exploited it, who, they were malicious. They were doing it to steal ETH from the sushi swap pools. And then there was I guess you could call him a white hat hacker, who did the 40 quadrillion mint and drained the pool completely, and then sent the remaining ETH to us. I think at that point, it still would have been better for us if that attacker had just notified us, but it is what it is. So the net result of everything was that the token was effectively infinitely minted, and then the Uniswap and sushi pools were drained of all their ETH. And, we got back a decent amount of the ETH in those pools, but not all of it. And since we have come out with a mitigation plan where we've released a new token and distributed the ETH that was returned to us, but I'll let Ted talk a little bit, and we can get into the future of the token and of the protocol a little bit later.
Yeah. Hey, Ted, real quick. One of the things that I'd like to make sure is clear for you, 𝗂𝗵𝗏 especially, and of course Ted as well, is being on the behind the scenes in the developing space in DeFi can be daunting. It is a responsibility almost that you voluntarily take upon yourself, because you want to be a part of what's happening. So while there might be people who have thrown a lot of fault towards the cover team, 𝗂𝗵𝗏, you, or other devs, I would like to say that the fault being assigned to the developers and to what has happened, or to the auditors, etc. It is a learning experience, and everything that we've seen here is it has been worked on, and Ted is going to explain how it was mitigated and the revival. But 𝗂𝗵𝗏, I guess I'm trying to make you feel a little better emotionally.
Yeah,
but it's not really your fault,
Yeah, can I add something? At the end of the day, it is our fault to some extent. We're the ones that didn't catch the error. But it also, we're humans, and security in DeFi is tough, and we're trying to build products that will change finance and do it quickly, and things happen. We all feel terrible about it. I do want to point out also, because we need to clear the air a little bit. There's a lot of people that may have lost funds, and they blame us, but we, as a team, we haven't sold any of our tokens. I don't know if everybody knows that, but we have tokens that were distributed to the dev team, and we have a vesting schedule. But even the tokens that are vested, the team still holds on to them, and we haven't sold any of them. And so that, we're doing this for the long term of the project and for the long term of DeFi. Obviously, we would like one day to be compensated for it, but we also we want this project to be a success. So I just thought that was worth saying.
Yeah, no doubt. It's going to be very important for anybody who gets involved with Cover Protocol or token holders alike to be insured, if you will, not insured in an insurance way, but be convicted that the developers and team are still 100% in it for the long term and it to win it. So Ted, let's talk about that. How has the revival process came along? What have you learned? What's on the horizon? Give us the quick and dirty.
Well, I've learned that. Well, see, different to 𝗂𝗵𝗏, I'm not a developer myself, so coding isn't my background. So, if if anything, I'd probably make sure I've got a defibrillator somewhere along if I'm going to work in, DeFi this closely again. The experience to me was a shock at the time. I mean, yes, you're right. Cucumber was up at the time with me. Now, look, a lot of people will say, well, why didn't you say something? Why didn't you come out on Twitter to say anything? Well, at the time, the exploit was quite small when we were alerted to it at the start. And I mean, you're kind of damned if you do and damned if you don't in this space. I mean, we had a quick discussion about it, and because we didn't fully understand what was going on, the last thing we wanted to do was actually announce it, right? So that there was this announcement that, hey, we've got an issue. No one's going to stay away. It's like, can you just leave our contracts alone for a bit? We just want to figure this out. Like, no, someone's going to come in and take advantage of that if we announce it. So we tried to make sure that we could solve what was going on. And at the time we actually had the multi-sig actually ready to sign for the stop of so we could stop the minting in the blacksmith contract that we had a problem with. And funnily enough, at the moment that we had Kiwi up and awake ready to sign that, I'd refreshed Etherscan, and that's the moment when we had more numbers than I've ever seen in my life as a token supply. So, that was an interesting experience. And the learning from that, really is, we did everything that we possibly could from a safety standard. We got the audits. We've partnered with Yearn. It's not just auditors looking at this. We've got some really smart people that look over our code regularly. So, to have it found by chance was gut-wrenching, but it's allowed us to remove it. It's allowed us to make some changes now to the 𝗵𝗶𝗶𝗵 token that I think for the better in the long run. So more fitting in with Andre's and the Yearn's ethos is around removing the need for farming rewards. So farming rewards are more of just a dilutive, and it's not really a sustainable way to generate income for liquidity providers or market makers. So we've gone with the notion that we're going to stop all those rewards and build this off feeds alone. And then on top of that, it's around, we wanted to make sure that we're capital efficient. So we've shifted our focus from it being a farming token to it is now its governance token. And then it'll be how do we add more utility for the 𝗵𝗶 token within the 𝗵𝗶 protocol? And that's going to be something that we work with our community and make sure we get that right. But I think the really important thing is that we've just been concentrating so hard on the V2 contracts. Multiple audits will come out of that to make sure that those are fully reviewed before we put those out into the market. And I mean, Cucumber's probably mentioned it very shortly, but we're pretty excited for V2. It creates a lot of things that we've been wanting. Capital efficiency is one of those in regards to how our capital is used in a pool. But it also gives us the ability to be a bit more robust in these markets that we're creating, and no longer just be a binary bet on a protocol coverage. And hopefully in the very, very near term, we won't be just covering protocol risk either or smart contract risk. We'll be actually providing some actual financial risk instruments.
Right. Cool. That's awesome. So not only have you focused on getting the new 𝗵𝗶 token out and compensating those who were affected and solving all the problems in a public and PR manner, right? But now we're focused on really improving, getting V2 going, and basically building out the original vision, if you will, that has changes every few days. It seems there's different things that come up and adjust and change paths. But effectively, there's a newfound desire and focus on really getting this to be the best it could be. And, now that everything that has happened is in the past, you guys are, as a team, are working to basically probably harder and smarter now, even after what has happened, as you said, from what you've learned, right, to build 𝗵𝗶 protocol to be, as best as it can be. And that is exactly what the 𝗵𝗶 token holders want to hear, right? Those who are on the team, who participate in governance, those who are community members, those who are, who help on the marketing side, all side, right? For the betterment of the DeFi ecosystem. That is effectively, where your time is best spent and what you've seen as to be the next step. So I'm extremely happy to hear that, whether I am a holder or not, which FYI, I did have some tokens, right? And the hack happened and I got reimbursed. Totally cool through the whole tool and the migration system. We didn't really touch too much on that, but obviously the new token is out and about with V2 coming. So yeah, I mean, that about it, like, explains it. I mean, I'm trying to think of from a consumer side, like what questions I would have, but I don't really want to bog you guys down with kind of on the past. But needless to say, I'm excited for what's to come with the Yearn ecosystem with Cover Protocol. I mean, do you guys think that we missed anything that somebody who didn't hear this would want to know?
Yeah, so I think the questions that we keep getting, of course, are, why do I not get any of the new cover token? And that, we had to make a decision to take a snapshot at a certain point. And what was really important to us was that long-term holders of the token were remunerated, and then also that the exploiters weren't able to claim any of the new token, right? And so that's why we took the snapshot where we took it. That had the unfortunate effect that there are some people who then sold who bought cover token after the snapshot, who then are not able to claim the new cover token, right? Those are the people that end up losing in our plan. And that's unfortunate, but we couldn't make everybody whole. That was just the reality. It's impossible to make everybody whole. So we did something that we think makes the most number of people whole, and especially the people that were long-term holders of the token. So that's basically why we did it the way we did it.
Cool. Yeah. I mean, there was a lot of speculators who were buying the 98% dip in an attempt to make a flip. I'm sure some did just that. I'm sure some got burned, such as the game of speculation.
Exactly.
I'm glad that you cleared that up.
But and so we're really excited about V2. By removing the farming, I think we've simplified things. So now that we can spend more time focusing on what really matters, which is building out the coverage part of the platform, and getting V2 out into the market. So in some ways, maybe this has been good for us, but obviously we could go back in time. We would have fixed that vulnerability when we released the contracts. So.
Money. Yep. Cool. Well, that sounds good. I appreciate you coming on and being open about this. Obviously, it's probably a touchy subject, and I'm sure this has been on your mind at the end of the night, often with your head on the pillow. It's as weird as that sounds. I mean, this responsibility that you've endeavored on is, it comes with ups and downs. Here we are trying to build out the rest of 2021 strong. And I'm glad to be around to see the next stage and evolution of Cover Protocol. That being said, any closing thoughts, Ted or Cucumber?
I'll let Cucumber finish off with the final close. For me, it's just you're right. You do take on a big responsibility when you decide that you want to build a project here in DeFi, especially when you've got TVL. You've got other people's money at risk, and I feel terrible for the speculators, but I'd feel worse if the LPs lost all their money. To be perfectly honest, I mean, without LPs, we don't really have an environment for those speculators to come and trade in, and they take on a big risk already by locking their funds up in these protocols for you to trade with. So, that's if anyone was going to try and be made whole, it was definitely them to start off with, and then at the end of the day, trading's trading, and it's a game of information, and hopefully some people will learn that, that Etherscan does exist and that you can use that to your advantage. And if this is the first time that you've understood how Etherscan can work for you, then learn how to use it. It's a great tool. It's the whole, it's everything that you need. It's to the minute data. So hopefully we'll be able to also help use that in the future as well to provide better products.
And Cucumber, if you want to wrap us up with anything else that...
Sure.
Yeah.
Sure. I just want to reiterate, everybody on the team feels absolutely terrible about what happened. I get, like we've said before, this just has to be a learning experience for us, but just rest assured that the team is still committed to the project. We haven't lost a single person. So it's still the same group of 6 of us, So we're gonna carry this through and try to make Cover Protocol the best project we possibly can. So
and one last thing is that the team is we're in the process of going through what those initiatives are. Well, we already have a few worked on, but we're putting together a fund that's donated by the team, and that will do a number of initiatives with our own kind of team tokens to try and provide some extra things in DeFi that maybe just aren't there today.
Right, and Ted and I have already donated to that fund. So just for people to know that, like, by doing that, we hope that we have this fund that can also be used for marketing and possibly hiring other devs and stuff to further the protocol. So we're putting our money where our mouth is.
Good. And that is what the DeFi ecosystem as a whole wants to hear, especially the Cover token holders. And again, we appreciate your openness and ability to share transparently. And we assume from a public veil of good actorship and wanting to make the best for everybody. And obviously that is verifiable on chain with what's happened and what's been explained. And we expect, Cover Protocol to rise hard, not just in price, but in terms of TVL and community and overall as a narrative for the DeFi space as a big part of that quote unquote insurance. We expect Cover to be right up there, and we're looking forward to the growth at DeFi Slate. And I know y'all are, and everyone who is listening to this is. So again, I appreciate you guys coming on. Y'all have absolutely crushed it. What's following, if you're still listening, is going to be a great podcast. I mean, really explain the protocol well, what's going on, insurance, what's big in the narrative, themes and trends that we've explored, a bit of shit posting in there as well. Ted's got a good accent. Y'all will love to hear that one. And yeah, sounds good, boys.
Thanks a lot, Andy.
Thanks, Andy. Appreciate your time, man.
What's up, guys? It's your boy Andy here today with another episode of DeFi by Design, episode 20, big 20. We've been at this for a few months now, actually. It's freaking crazy. A lot of stuff going on. DeFi is going crazy. I mean, there's just new stuff, new farms. Recently, there's been a rebase token boom. Everyone's trying to find the best way to create the next stable coin and rebase their way to being a millionaire while all others get wrecked. Welcome to the nature of the nascent markets. Robbie, how you doing today, buddy?
Oh, I'm doing well, Andy, as always. It's a beautiful day in Florida. I haven't had a day this nice in a while. It's been kind of chilly down here, but I'm doing well, staying with it. Exams are finishing up and turning my head to crypto and DeFi full time. So I'm happy to be back on DeFi by Design as always. I'm super excited to be kicking off episode 20 with 𝗵𝗶𝗴𝗵 and Ted from Cover Protocol. I'll hand it over to them. Ted, how's it going, man? How you doing today?
Yeah, I'm doing great, Rob. Thanks for having us on today, guys. Really appreciate that. Not as sunny where I am. It's early morning, Melbourne, Australia. So enjoying a nice big coffee.
Nice. And 𝗵𝗶𝗴𝗵, how you doing this morning, buddy, or this afternoon, I suppose?
It's actually the morning for me too. I'm on the West Coast right now, but it's not as nice as it is in Florida. I'll tell you that. Yeah, I'm doing pretty well. Just excited to keep going with Cover, and we're rolling out governance in a few days. I'm looking forward to that.
Super. Maybe you guys could give a little bit about yourself, just a quick intro, how you got started into DeFi and crypto, and leading up to Cover and how everything got started there.
Yeah. Okay. Well, I'll give my bit as to kind of how I got started in crypto, and I'll leave the Cover genesis story up to 𝗵𝗶𝗴𝗵 a little bit. He tells it quite well. So. Myself, I've been in crypto for about 3.5 years, came in before the last large bull run, didn't profit well enough from the last bull run to quit my job then, spent 3 years in the trenches in the bare winter, learning and studying every day. But I come from a traditional finance background. So I spent, nearly 18 years, doing things across finance and insurance in Australia. I worked for GE Capital for 10 years. And recently, for the last 5 years, I was involved with, doing a lot of commercial type, lending and insurance. So DeFi really stood out to me as it started to progress in the Ethereum network late last year. And I really pivoted towards, I wasn't really a big Ethereum back then. So I pivoted towards DeFi then. And, in the last, 9 months, we've just seen so many primitives that are available in traditional finance move to DeFi. And it's just so exciting now. And when the opportunity came along to, put down the pieces for a different way of doing a KYC kind of coverage protocol that met all the culminations of my history, and I really wanted to be a part of that. So that's my foray into crypto, really, and the 𝗵𝗶 team. But I'll let 𝗵𝗶 give the genesis story of the 𝗵𝗶 protocol itself.
Sure. So I guess I'll start with my own personal introduction first. So I also come from a traditional finance background, specifically fintech. I've been writing financial web applications for 7+ years now. And then back in 2017, I got into crypto first, mostly with Bitcoin, but then naturally, you move on and look at other things as well. I was able to quit my job in early 2018. Obviously the timing wasn't that great, but it still worked out for me. At the beginning, I was mostly programming trading type applications. But then, this year with the boom in DeFi, I got more interested into smart contracts and actually building applications on top of Ethereum. And so, I think it's just been great. I think it's the best product market fit that crypto has ever found. And it definitely fits my background skill set really well. So as far as the genesis of 𝗵𝗶 protocols, so basically what happened was Alan, one of the other founders, he created Safe, which was a shield farming opportunity. It was basically, for those that don't know, you could stake NFTs that represented coverage on Nexus Mutual, or you could stake your wrapped NXM. And then there was a pool too also on Balancer with wrapped Nexus Mutual token, Safe token and DAI. In any case, it blew up. He got retweeted by Andre, and people just thought that the whole farming concept was super, super cool. And so he got hundreds of millions of total value locked within a couple of days, and just a lot of publicity around it. And I've been interested in the insurance space in DeFi for a long time. Not so much because of covering smart contracts, which is what we do right now, but because of the long-term opportunities there to cover things in the real world, hopefully, right? Which has been the dream for crypto people forever, of course. But in any case, so I had an idea of a protocol that I think could cover smart contracts, but also extend to all those real-world applications one day. And so I PM'd Alan on Discord, and we started chatting about it. And he liked the idea, and he started talking to other people on Twitter and other parts of social media about it. And there was some validation of the concept. And so we decided to work together. And, also because of the success of his original farming concept, other people started reaching out to Alan, and suddenly we had a team, out of nowhere, including Ted, of course. He reached out to Alan very early on. I'm not sure the exact way that happened, but suddenly we had a Discord server with a bunch of people in it. And we had a team, and we had a concept, and we started working, and we found that we actually worked as a team, that we could get stuff done. We could ship code. And so we've been able to launch this in, I guess, a little over 2 months now. And it's going great. Like I couldn't have imagined how much traction we would have gained so far a few months ago.
Yeah, it's been wild. The story was crazy. I mean, all the migrations was just like, it almost seemed like the whole Safe concept and 𝗵𝗶 was just going to kind of fall away into oblivion there at the last second. But you guys obviously pulled it together. I mean, the collaboration with Yearn and obviously the price increase, which we won't go into too much on that. But overall, it's been quite the rebound. Quite the story. I mean, obviously a very needed concept in DeFi, here we are putting together anonymous teams, kind of like Rope did. It just kind of reminds me of that. It's just crazy when you put some smart people in a Discord or a Telegram server, what can get done, quickly and how well people can collaborate.
Yeah, absolutely. So I think it's one of the first times in human history where that can happen. I mean, where you can just take people from all over the world and they can organize so effectively. We've just got all the tools now at our disposal. It's really amazing, to be working with people from all over the world.
And you guys were able to ship in 2 months. And I think part of what you said was the validation around that concept. Maybe early on, it was a mentality of, all right, build it and they will come. But that's not really what happened with you guys. It was more like, oh, here's an opportunity. It already has kind of an organic community. Let's attack this problem because we have the tools and we know how to get it done.
Yeah, the way I describe it is I think that I had the concept for a long time, but I didn't have a platform for it. And Alan suddenly had a platform for it in terms of, like you said, that community and just people that were interested in us building something for them. And so it was just a natural collaboration between the two of us as a result.
Sweet. So I'm definitely curious as to the Yearn ecosystem growth, kind of what you think of it on a broad scale, just like the acquisitions. Obviously, y'all are a part of it, but overall, what do you guys think about that? Just the overall growth of that concept, y'all being a part of it. How did that happen? What's your thoughts on like the Yearn takeover, if you will? And how's that been going?
Yeah, that's a really good question. I mean, a lot of people have this concept of a merger where, the traditional sense is you'd come and buy out their stock, right? Or you'd have some sort of option where, you'd remove their token from existence and everyone be moved over. But that's not what it is. It's really an alignment of our thought process, of our values, of the things that we hold important. So things like capital efficiencies, something that's very dear to Andre and creating that, and just being able to remove friction from the process. So what we've got through Yearn now is this packaging of the DeFi primitives into one kind of ecosystem, and it's not designed to kind of make sure that it's all built together, but we can collaborate that dev resource, we can collaborate the operations resources, we can collaborate the marketing resource, we can collaborate all those resources now to try and get the most out of it. And a lot of people think that, now that it's a takeover, it's not the case. We are building our own core product, our own core protocol, and going with the original vision that we've always had. And the guys are still working on our V2. But for the Yearn relationship, there's things that they're going to need from us to make sure that also works in their ecosystem. So what do I see from them? I see them just creating a frictionless, capital efficient ecosystem.
Especially with like the collaboration with &𝗏𝗏𝗏, basically the same product almost with the vaults, basically being able to increase TVL, put strategy creators together, and just grow that. And I mean, I think it was definitely a good idea that everybody who was a part of it, all protocols, all people, are all able to still work on their own token, their own protocol, their own vision, as you said, because I mean, I think with a little too much of that takeover attitude, you start to force yourself into like the centralized entity realm. And that's of course against all things that DeFi would stand for. Extremely interesting and a net positive on the ecosystem. I would agree. I mean, like the news, the people just can't get enough of this. I mean, I don't know if it's the Andre effect, but like there's just like this realm of like a pedestalization of Yearn and Andre. And I mean, here for it because it was like the first fair launch, but also the pedestalization of any one figure can be detrimental to a greater ecosystem.
Yeah, and look, absolutely. I think we get a lot of benefit from it because who doesn't want Andre having a look over your code every now and then, and just suggesting ideas of how it can improve here or how it can improve there, or how you can game the system for users a bit better. So, I mean, his insights are valuable. Right. And, a lot of people see him as this overarching demigod. It's not the case. I mean, the guy's out there constantly shipping code. That's what he loves to do, solving those problems. And he's got a massive team there that he leans on. So it's definitely a team-based ecosystem. And, we're all trying to row the same way as well. We want to grow the TVL. We want to bring new users into the space. So a lot of the concepts that have also come. So if you think about that 𝗏𝗏𝗏 type thing, I mean, at the end of the day, they're more looking towards that institutional level type of investment. So, it makes a lot of sense as well to kind of, if you've got like Pickle, 𝗏𝗏𝗏𝗏, people say, well, they're kind of a similar thing. How does that fit into an ecosystem? It's like, well, different users use different tools for different things, right? So Yearn, their UX is very much towards the everyday person coming along and just doing something with their stable coins, right? Or being able to get more return on a particular token. Whereas you look at Acro and they're definitely towards institutional level investment. They want people that are, institutional, sophisticated investors, know what they're doing and going to have high TVL. So they're aligning themselves to the different user bases as well, without having to change their own ecosystem to meet all user bases, which I think is quite smart. That's the beauty of these Legos, is that you create the core component deeper in the stack, and everyone can build on top of it.
Oh yeah. And that's especially important now that it seems like more everyday people are getting introduced to DeFi, whether it's from the Bitcoin rabbit hole or starting with Ethereum now. Andy and I were just talking last night, and some of those normie friends of ours are starting to hit us up again. Like, oh, how do I get started? Where do I go? And normally that's a top signal, right? And it makes like the people that are here every day kind of weary of, when there's newcomers coming in. But it seems like Yearn is providing that like an entrance to the rabbit hole. And then as you dive further and further, maybe until you hit Acropolis, and that's where you get some more like complex functionality. But what Yearn is doing, exactly what you said, removing the friction from the whole process, allows people to explore much more seamlessly. And to someone that isn't familiar with what's going on, a simple UX and not a lot of hesitancy and friction going from application to application is really important, because they're going to be able to explore just more naturally, and it'll be a more seamless flow.
And I think there's something to be said about the buzzword of DeFi as well. I mean, we're called DeFi Slate. There's DeFi this, DeFi that. There's DeFi everything. CoinGecko, they have a DeFi tab. There's a lot more people that are definitely interested in how to DeFi now, rather than just like how to buy Bitcoin, how to Coinbase. It's like, how do I DeFi, bro? Like come on.
Yeah, absolutely. Yeah, I've got normie friends that are in the kind of financial planning, wealth management type roles, and they're saying, okay, you're going to have to probably enlighten me a little bit more into some of these DeFi things, because it seems like you've got access to stuff that I would have access to. It's like, yeah, I do, man. Except I don't have to KYC myself. I don't have to be an accredited investor. And I can basically tell you guys charging fees to go and get F. And that's the beauty of it, right? Is remove that middleman, remove the fees, remove the friction, and enjoy managing your own finance. So I think the thing that's missing right now to how to DeFi is some serious learning curve education, because that's definitely it's a different level of education. We're not teaching people how to use a wallet. We're not teaching people what a blockchain is. If you get to DeFi, you should have an understanding of some of those things already, and that's where you should start. But yeah, that DeFi primitive, it's definitely a steep learning curve. So,
and then you get into like yield farming and shield mining and coverage and decentralized derivatives and options and all these things, and it's just like it's a lot. It's a lot of thinking.
Well, if FTX would add a sleep perp, I'd happily short it.
A sleep perp. I'm done. Oh my gosh. So for those of us who don't understand what shield mining is, because it's been a thing with Nexus, and I'm actually definitely keen to explore the relationship and kind of how you guys view that collaboration versus competition to overall ensure the entire industry, because obviously there's less TVL locked in those two protocols than there is in all of DeFi, but we'll get to that in a second. But for shield mining, definitely curious if we could get a beginner's technical intro on kind of, what is shield mining? So if I hear this concept again and I'm listening and, I can kind of understand what.
Sure. I mean, I'll take that one. So shield mining is basically taking your coverage of something in the DeFi space. Up to this point, it's only been smart contracts. The only coverage that's really offered is smart contracts. But it's taking that coverage, staking it, and then earning a farming return from that coverage. So basically, it's incentivizing you to cover your yield farming investments, to cover the smart contracts that you stake in. It's as simple as that. Previously, it was done by taking NFTs that were wrappers around coverage on Nexus Mutual. For us, it's a little bit easier because our coverage is actually tokenized directly as a fungible ERC20 token. So you have a token that you can just stake natively. But it's as simple as just earning a return, earning a yield on your coverage that's covering some other investment that you made in DeFi.
Right. And so how do I get coverage on cover? And then how do I shield mine? I think I understand, but for those who are listening.
Sure. So coverage on our platform is as simple as owning what we call a claim token. on any of the protocols that we cover. And so you can just buy that claim token on Balancer. You can go through our UI, or Yearn is building out a UI now that will allow you to do it directly from the Yearn website. And then once you have that claim token, which is just a normal ERC20 token, you go to our UI and you stake it in our shield mining tab, and then you start earning cover tokens. It's as simple as that. And then we have a few protocols now that are also incentivizing with their own token. Namely Badger and Boring DAO. So sometimes you can double up on the rewards like you can on Curve in some of their pools. So it's pretty cool.
𝗂𝗵𝗏, could you explain a little bit more about the separation between Cover and Nexus Mutual, and kind of how that relationship started, and then maybe you branched out and started doing some different things?
Sure. I mean, the relationship at the beginning was more of, well, they're really the only coverage provider out there. So if Alan were to do shield mining, which he wanted to do, he needed to find a way to make it work with Nexus Mutual. And the way that he did it was through NFTs, but there wasn't really any relationship there. I mean, we have spoken with their team, but we're going about things in a separate way. We have a completely different approach to them. I wouldn't say that we're antagonistic or in any way. I mean, neither one of us covers even close to the total value locked of DeFi. So there's just so much room for growth on both of our parts, but we do go about things in a different way. Our capital is from the community, so it's really community driven coverage, whereas they have more of a traditional setup with an actual nexus made up of members that pool their capital together. So I would argue that theirs is a little bit more centralized and ours is a little more decentralized, but the trade-off there is that they have better capital efficiency than we do right now. So yeah, I mean, I would say that we're both working towards the same goal, which is to cover DeFi, but neither one of us can do it on their own. So in that sense, we're kind of partners, but other than that, we're not really working closely together, and we definitely are approaching things from a different, technical perspective. So yeah.
Yeah. We had a podcast with them pretty recently, and they're doing some interesting things, but it doesn't seem as really user friendly as Cover, because like you said, you can just go to the UI, buy a cover token, and then bam, you're covered, and you start shield mining.
Yeah,
well, I mean, go ahead. Sorry.
I was going to say you need KYC, and you got to get accepted into the mutual.
Yeah, I would say that KYC is the biggest barrier to entry from our perspective. The other major difference is that Nexus, they try to spread themselves wide, which means that they need to cover a lot of protocols, but they don't cover any of those protocols particularly deeply, so they can't offer more than a few $1 million of coverage on any protocol, whereas we're better at going really deep, where we can offer a lot of coverage on one particular protocol as long as the capital gets staked on that protocol. So that's kind of more of the difference. So they're basically trying to create a bunch of diversified risks for the mutual, and they can do that by covering 100 different protocols. So those are the two main differences, I would say.
And that makes sense. That is the way to make sure that the underwriters basically are getting, their fair share of not getting all the claims in the world and then having to deal with them all at once, deep, as you were saying. But I mean, I'll have you guys know that I was speaking to a few buddies last night about this upcoming cast. They're decently interested in DeFi. They might own some Bitcoin or some Ethereum, nothing crazy. And they were just absolutely taken aback by the concept of insurance on chain, decentralized insurance, figuring out ways to basically pool funds together to, insure decentralized protocol, because obviously very, very risky to be using DeFi. But that concept, I mean, to them was just extremely interesting. So I think that can speak on the growth of, what's to come.
Sure. And to be honest, what excites me the most is really not even covering smart contracts. It's all the other potential applications of decentralized money coming in to protect risks in the real world, and not to have that insurance company in the middle and let the market actually choose the price for that coverage. I mean, that's our long-term vision, of course. But in the short term, we have to make DeFi safe so that people feel comfortable using it in the first place, right? And that's so we need to solve that problem. That's what we're working on first. But yeah, I mean, go ahead.
Kind of on that point, sorry, I just read this tweet from one of this guy, Wi-Fi entrepreneur on Twitter, GG's buddy. He said, and it kind of goes along right with what you're saying about kind of getting rid of the insurance companies, is what's next for cover to cover. It's kind of like a meme. The goal is to allow people to get coverage on anything? Does that mean cars, boats, life, home?
So, we need to be very careful here from a regulatory perspective, obviously. But yeah, the sky's the limit. I mean, one of the reasons why we tried to design our model the way it is because it can apply to pretty much anything. I think what's going to make most sense after smart contracts, though, will be type of parametric risks. So those are things like natural disasters, for example, or flight delays, flight cancellations, stuff like that, because those are really easy to verify externally, and they come with less regulatory risk compared to, say, doing life insurance or something like that, right? Which is a heavily regulated industry in most countries, especially the United States. So I would say it's probably more like natural disaster type coverage that we're going to go into next, and then other things that are native to the crypto ecosystem, like risks of gas prices being too high or things like that. Things that we can directly verify on chain will always be the easiest to cover. And I think our model is easily extensible to all of those types of things. But in the short term, what we're focused on is improving our capital efficiency. I'd say that's the real weakness of our protocol right now. And so in our V2, we're going to be addressing that. And then after that, we can start looking at other types of risks to cover.
Gotcha. And the capital efficiency seems like a direct stepping stone into those other markets. Because obviously there's insurance providers in the real world that are providing earthquake insurance, flood insurance, hurricane insurance. But if the goal of cover is to start breaching into those areas, it seems like the capital efficiency is going to need to at least parallel those real world insurance firms that are providing rates right now. And, if the capital efficiency is better than what they're providing, it seems like prices would go down. And now earthquake insurance, hurricane insurance is cheaper than it was before.
Sure. I would think that we have several advantages, though, already without even achieving capital efficiency, which is, first of all, we don't have any paperwork middleman costs, right? And depending on the industry, that can be a very large percent of the total premium that you pay, right? The other thing that we will have is the ability to have completely flexible coverage, whereas currently with a lot of types of coverage, they have mandated minimums and all kinds of things like that, which cause prices to be higher than maybe the consumer wants them to be. So right off the bat, we won't have to deal with those kinds of issues. So that should make things cheaper. And so then if we can solve the capital efficiency question on top of that, then yeah, I think DeFi insurance will just be way cheaper than what's currently out there.
I wonder what y'all's friends and parents and my friends and parents think about all this. I hear, building systems, building decentralized insurance, completely new, primitives on this thing called Ethereum.
As soon as I explain it to anyone in my family, because I left my full-time job in September this year to come and do crypto full time, and they go, explain it to me, and within 5 minutes I can hear their eyes have glazed over, and they have no idea what I'm on about anymore. And to me, actually, every time I do that, that's just a reminder about how early we are, how much further we have to go. And when you try and explain this, and within 5 minutes they just have no idea. It's kind of like, well, we're nowhere near to the point where this can be properly adopted until you can have a conversation that lasts more than 5 minutes with someone on cryptocurrency and DeFi.
Hey, Ted, I'll tell you what, if you give me a call every week with that accent, man, I'll listen to you for as long as you want, buddy.
Oh, crikey.
That's funny. Rob, I think you're muted.
Yeah. I see the same thing, Ted. And it seems like there's no interest in learning. And maybe that speaks to just like the normalized nature of, people that we might be talking to in our direct family, and like that, there's not so much interesting about the insurance market when you first look at it. Like how much does the normal person need to know about the capital efficiency of an insurance market? If you were talking about the system, 50 years ago when they were redoing insurance, I don't know really the history of the insurance market, but people's eyes probably glazed over back then too. So I completely agree with you that it does really show how early we still are. But when you do start getting into those conversations with people that are in similar industries and maybe even traditionally in that industry, and haven't heard about the DeFi way to do it so much, those people are interested. And that seems to be the validation for actually what's going on and to keep on progressing this direction.
Yeah. And I think that speaks to like this question that we literally just got on Twitter about, kind of getting the retail market involved. Friends, family, other people, and even people just in DeFi, people who own Bitcoin or own Ethereum, considered to be retail traders. And, this speaks a bit on like the roadmap as what is the plan to simplify buying coverage for the typical retail market? And then on the second half of that is what's the typical makeup, if you guys might know, of the users who are buying coverage now, and how do you see that changing over time and developing later in terms of the users who are actually buying coverage, and how you can make it easier for them?
Yeah, well, I think for the retail customer that's coming into the market to try and use DeFi, in my history, I spent 10 years basically doing retail finance. So when you're trying to work out how to increase your market share, one of the best things you can do is take that customer journey and make sure that you can have, you can plot the experience along the way and any pain points. The beauty with DeFi is that you can remove a lot of those pain points straight off the bat because there's no middle person, you're dealing directly with the protocol. So it really comes down to how smooth can you make that journey? How less steps can you take? How much can you automate for them to literally make it the click of a button? So it'll come down to, for greater retail exposure to buying coverage, it'll just come down to making sure they understand what they're buying. Yeah, so a level of education, making sure that it's easy for them to buy. So when they are buying it, it's a easy process and an understandable process. So it's not a confusing process that, a lot of people went to our original UI and were kind of like, am I minting this? Am I buying it? Like, how am I going through your journey? And that was some great feedback. And Yearn have definitely applied that with their version of the purchasing of cover on their platform. So these small little changes will help get us there from a front end point of view and that experience. But I'll let 𝗂𝗵𝗶𝗵 talk to some more of the technicals around what we can do there to improve that. But the makeup of users so far are just either they're definitely not bettors in the market. They're people that actually want coverage. So if I think about the 𝗵𝗶𝗶𝗵 incident that happened, and unfortunately, $19 million, and we would have loved to have paid out all of that. The misconception there was everyone thought that we were going to pay out 19 million and we were about to go insolvent. But as 𝗂𝗵𝗵 mentioned, we don't use any of our own capital. It's just what's available in that pool. So the majority of those holders were users of the 𝗶𝗶𝗶 platform, or they were also liquidity providers. So they may have already been holding a claim token after minting it and provided it. So we've definitely got some smart people in our community working on the analytics side of it to show us purchasing power. So how many claim tokens are being bought versus minting, available and what's available in the pool versus what's already been purchased. I mean, these are all good indicators as to what the risk model is in that pool as well. Because if you've only got, say, 20% of the claim tokens purchased, and there's this big pool of additional tokens, it might be you may want to just go and provide liquidity there, knowing that the majority of those claim tokens are going to be owned by liquidity providers, and that only 20% are going to want the additional claim. So you're likely to only only be up for a very small portion of the funds if there was a claim. So yeah. That's probably from a high level view that I can get into without being technical, but I'll let 𝗂𝗵𝗵 go through the technicals.
Yeah, and I was just thinking it's probably a lot of degens because the only people that are using DeFi are the degens or the power users, we call them, but smart power users, people that understand the risks and this might be a little risky to play, why don't I get some cover on that? But yeah, I mean, as far as we know, and as far as my experience goes, I mean, there's very little chance that there's anybody with who doesn't understand how to use, 𝗷𝗍 or Uniswap who's buying cover, right?
Yeah, exactly. I think one of the key things is that you're right, the degens, right? So degens is probably one word, but the funny thing is that those degens have been playing in power using for so long are actually the type of people we want to be liquidity providers. There's a good chance they understand how risk management works, right? And they've been able to apply, well, maybe not. I mean, but there's a good chance that they do. So, with our platform, you need to understand risk. I mean, being in coverage or any type of insurance market, I mean, that's key, right? Is understanding risk, probability, and managing that. So if you're not already of that mindset, then it's probably not the protocol for you to be a liquidity provider or a coverage provider. I'd probably say outside of that until you understood that, because, a good example is, I wouldn't go and put all of my coverage to farm in one protocol. You're exposed if that one protocol has a hack, right? So, and then you're up for everything. So, there's some other, user experience things that we can do and help liquidity providers spread that risk at the time that they go and actually put their DAI in.
Cucumber, were you saying something? I think I just overtalked you.
No. I just had been turning my mic on and off. But yeah, I mean, I'll add to that real quick. I think absolutely our users are power users and not even your run-of-the-mill DeFi user at this point. I think your run-of-the-mill DeFi user is just not buying coverage, period, right now, right? That's just the harsh reality. And in order to us to get to a point where the average user does buy coverage, I think, first of all, risks have to go down, unfortunately. And I think they are. I think through a combination of, greater awareness about the need to get your code audited, just more and more hacks occurring, I think that will eventually cause most people to just not even pay attention to the riskier projects that released their code in a couple of days and didn't get it audited with anonymous dev. And then once that happens, I think the perceived risk of all the protocols will go down, premiums will come down, and then maybe coverage will become more affordable and more people will actually start buying it. But certainly right now, our interactions are with power users and people that really do understand the risks of the DeFi space. And so, yeah, there are a lot of challenges to expand that net. But, first of all, we need to solve some technical challenges as well. One of the biggest things that we want to do is right now we use balancer pools to sell the claim tokens, but we want to introduce a layer 2 order book to the buying and selling of claim tokens. And we're talking with a few potential partners right now. So hopefully we'll be able to make that collaboration soon. But that will help a lot because then there will be less slippage when people buy the claim tokens. So from a technical perspective, that will make buying coverage more accessible. Also, I think what Ted was saying about spreading out your risk across multiple pools is extremely important. So we can achieve that kind of risk management, but from the user's perspective, but the user is required to actually take the action to make that risk management. Whereas with Nexus, it's kind of built in. And I think that points out one of our challenges, but one of our advantages, which is we're a lot more flexible and we leave decisions like that up to the underwriter and the coverage provider themselves. But at the same time, since it's not built in, if that underwriter doesn't make the right decision for risk management, they can suffer a large loss, right? So actually building tools to make that risk management easier for them is something that we also need to do going forward. But I think we're so far away from having just your average finance consumer on the street interact with DeFi insurance protocols that we need to focus on our core user base still, which is people that have already been introduced to DeFi, and then let other people do the onboarding of the person on the street into DeFi, and then eventually, hopefully, into our platform.
I mean, you're talking about the average financial user. Obviously, anyone on the street is going to have insurance. Do you see kind of a bridge between the DeFi insurance ecosystem and the traditional insurance ecosystem? Or do you expect more of a revolution where these insurance companies are really going to want to continue doing their own thing? And, it's either going to be DeFi providing a cheaper alternative, or do you see it as some sort of merger or parallel where we could see some of these traditional insurance firms adopt DeFi strategies and protocols?
I'll give my personal opinion, then I want to hear what Ted has to say about that. But I don't think it will be traditional insurance companies. I think it's much more likely, though, to be tech companies that are already starting to integrate with crypto in general, like, the PayPals and the Squares of the world. I think it's much more likely that they will start offering various DeFi products to their customers. And then one of those will be coverage and insurance at some point. So I think that's probably the route that will happen. I think it's extremely unlikely it will come from your traditional insurance companies, though.
Yeah, I don't see us building out the same tools that we have today that exist in kind of even fintech, where you're trying to onboard a retail user that way ourselves. I think that's going to be absolutely driven by these neobanks. Like if you think about how Coinbase and some of these other guys are going, they're going custody route, right? So they want to do this custody holding of these tokens so that they can onboard users and have that kind of custodial process of crypto. So, I see more of that happening, and those guys being the ones to offer the insurance, because there's this way of still be able to charge a small fee. We're custodying you. We're doing the custody of your crypto. You don't have to manage any of that. You can just come and trade on our platform, and all the little fees will be built in there. So I see them kind of still extending to the DeFi stack, or still extending to the Ethereum stack to offer that insurance, but not creating it themselves. I don't see a fintech company coming in and changing the world with their upfront fintech design and adding crypto to the back of it. I absolutely see these neobanks as being the next stage towards onboarding retail users and helping manage their experience.
Yep. And I was listening to the Bankless podcast the other day, and they were speaking about this thesis, protocol sync thesis, which basically like eventually, because these DeFi primitives are so dense, they'll sync to the bottom, and any, UI or front layer, institution or CeFi provider will basically just be using them on the back end of their front end, which they will provide to, to retail traders and to investors alike. Super interesting concept. I mean, it just shows like the power of what's going on currently, and how it eats away at what is currently there, but overall in a productive way. Now we're about running out of time here, so I'm thinking, Rob, we should hop into a little bit of a rapid fire round off the agenda. We'll ask you guys some questions, a few sentences answer, and then we'll get on to the next one. If you don't want to answer, you guys can pass. We'll say whose name to answer each question, so that way that we don't get tripped up here. All right, I'll go first, Rob. I'm going off the agenda. Do you expect pushback from the Goliaths of the insurance industry? I suppose that we just hit that, but I'm curious as to what kind of pushback you guys would expect. Ted?
Look, no one's going to want their market share taken off them and they're going to let it go, right? So, look, I do expect some sort of pushback. I don't know what that looks like, though. So it'll definitely be about removing friction for them, for their clients, and making it quicker. It's going to need to turn around a lot sooner, and I think it's going to have to get cheaper as well. So I think they're going to push back. Absolutely.
Got it. 𝗂, could you touch on the tokenomics of cover and governance as a whole?
Sure. So we have a release schedule for farming, and that will end in about 6 months. So 6 months from launch. And then from there, we have a perpetual inflation model that kind of halves every year. But, we are releasing our governance module on the 15th, and then it will be up to token holders to validate that model and decide if there's anything that they want to change.
Gotcha. So not decentralized completely yet in terms of governance, but coming soon.
Yes, exactly.
Nice. And that's the way to do it. I mean, if you start off decentralized, you usually get screwed a few months later. It's just kind of how it goes. Is the covered networking protocol currently bottlenecked by the scaling solution of ETH? If so, what's the plan to work on it? I know that we touched on the L2 order book. 𝗂, definitely curious on that.
Yeah, so the L2 order book is the only thing that we could use from a faster base layer network. So if you could do order books on layer 1, that would be great for us. It would solve some problems, but that's really the main issue we face. Our core contracts really aren't affected by ETH and its scaling issues. Any
upcoming partnerships or just feature releases on the roadmap that you're excited to share?
Sure. So we're working on V2. I don't want to give a date, but I think we're pretty happy with it, and we're definitely making a lot of progress. And then the other important partnerships would be a potential layer 2 order book partnership. And then on top of that, we're always talking to many, many different protocols about them getting listed for coverage on our site. But but also then them also adding liquidity to help make that coverage cheaper. So, I mean, we're in conversation with dozens of protocols at this point about that.
Nice. And Loopring or ΔeFi would make a good collab on that L2 exchange. I'm sure y'all are obviously aware. Ted, will a percentage of fees from the use of the protocol get rolled back into the community at some point? Very broad question from Twitter, but yeah.
Look, it is a broad question, but look, at this stage, we wanted to go with this as a governance token. We wanted to keep it as non-fee accrual when we first released it for a number of reasons. But we didn't want to just have kind of rent-seeking users either from that point of view. I mean, it's probably been a bad bit of talk about that in the space. And we wanted the community to decide what they want to do with it, right? So, I mean, we've left a lot of those tokenomics for the cover token up to the community after December 15. So we just wanted to make sure that we had a scheduling and a supply that they were happy with. They definitely weren't happy with the first one we rolled out. So we worked with them very closely.
that was quite the little Twitter day right there.
It was an interesting day because it was also my birthday. So I spent most of my birthday kind of, swatting away Twitter trolls and, the likes. And, our team was caught in a very rough place. Like you just heard about our Genesis, it wasn't like there was this protocol. It was developed after the SAFE token. So, we've got these guys that have come along with this idea and wanted to try and, get the benefit of that, but also realize, hang on, we've already created a community. So it was this tough kind of trade-off, but I think they got there in the end really well. I mean, that's come around. So December 15, I mean, if you're listening and you're holding cover tokens, governance is live. We'd love to see the proposal as to what you think we should do with these fees and how they should be accrued to whoever, the users or to the protocol.
Yeah, our wrapped NXM yield farming days over summer will be right up in there, baby. Let's go.
Good man.
Oh, well, that was an absolute pleasure, y'all. Rob, what else you got for us? Anything else?
I think we're just about out of time, but you know what? You always ask one question that I like, and I'll ask it this time. If you had to be stuck in an elevator, you're going down an elevator, get stuck, whatever, and it's from someone in the TradFi or some celebrity somewhere that you could pitch DeFi to. Warren Buffett, Kanye West, whoever it is, who would you want to pitch it to?
I'll start first. I'll say Peter Schiff.
Got him.
And I would if I was stuck in an elevator with him, something inside me would just enjoy rubbing him up the wrong way about everything crypto related and just absolutely trolling him to his face. So
love it.
That'd be me.
Cucumber.
So I'm gonna say Dave Ramsey, just because I think, first of all, he's anti-debt and most crypto people don't have debt. So it fits his user base. But also, he just has a very wide reach with people that I think could ultimately really see the value in crypto. So I think that would be a really good bang for my buck, in terms of getting exposure.
Yeah.
He's like a go-to financial literacy person when I was growing up in high school. It wasn't that long ago. They would show videos of him in my econ class and talk about how Dave Ramsey does this. Yeah, I like that one. It's a good pick. All right. Well, yeah, this was absolutely a pleasure as always. Good talking to you guys. Andy, anything else?
Yeah, good stuff. No, I'm excited for the governance launch. Been watching for a while now and really keen to collaborate more in the future. Best of luck. And I'm glad that I could make time for this, as well as Rob and y'all as well.
Oh, thanks for having us on, Andy and Rob.
Yeah.
I really appreciate it, mate.
Yeah, thanks, guys. It's been a pleasure.
Peace.
You guys.
Thanks for listening to the DeFi by Design podcast. Until next time, DeFi Slate Team.